Hello, today is Sunday, the 12th of February 2010, and this chart is that of gold, but only during LBMA time frames. If you go to the web page, they will give you data for gold and silver going back to 1968. And on the gold side, they'll give you two levels, an AM price and a PM price. They don't do this for silver, they just give one variable per day for silver, but they give two per day for gold. So by theory, I can take the PM gold price and subtract it by the AM price and divide it again by the AM price again to get a percentage gain or loss for the day, which is what I've done. I started with 1. So this would tell you how many times it has gained or lost its value from a particular time frame. This goes back to the start of the second quarter, 1968. And currently at 11.5 cents, well, it's managed to hold on to 11.5% of its gain since it was like $35 an ounce. I don't know what time that the gold price opens and closes at, but by looking at this chart, if you were to short gold when the fixings open and then cover your shorts when it closes, well, you'd be doing pretty well, to say the least. Now this is a chart that contains 100 periods in each one. 100 days. So it's a 100-day chart going back to 1968. Okay, well, let's take a look at this now, only 25 days, using the charts that I like to use, which has the 18-period average. There is no dates, but there's 83 candles. Each candle represents 25 days, so 25 multiply 83, that's 2,075. There's approximately 250 days per calendar year, so this is about a total duration of about 8.3 years, or going back to around 2003-ish. I don't know what else is to say, but it's getting its butt smashed during this time frame. So let's do the opposite of this now, and this is if you were to just buy gold on the close and sell on the open every single day, going back again to the start of the second quarter, 1968. So to do this, I take the AM price and I subtract it by the previous PM price and divide it by the PM price again. For example, I don't know what time it closes at, but I know the European markets close around 11:30 New York time. So I guess if you were to buy gold at 11:30 a.m. and then sell it, I would guess around 5 o'clock in the morning, United States time, you'd be doing pretty well. In fact, it has gained 396.5, or we'll round it to 400 times more than its original value since 1968. And since 1998, or September the 3rd, when it broke out of this long consolidation range pattern, well, it still managed to gain well over 30 times its value. So we'll do this final chart now, and we'll, same thing as the most previous one, but what's interesting is if you take a look at this, I got 18-period average of highs, lows, and close, and the dots that you see in here, that's the 18-period average of closes. Well, do you notice in here that the match with the high, well, the 18 moving average of highs is 327.5, and it's 323.5 for the 18-period average of closes, because it usually closes at the highs. It keeps going higher. In fact, this upper band, which is, it's not designed for markets to trade above this line or below this line, but it's doing exactly that. in that of trading above the line for quite some time. That's because it keeps going higher and higher. So the overall reason for this is to point out that I don't know the reason why, but this is happening. For whatever reason, they just crushed the market down during the European hours. And then on the off hours, the market's been going high. It's been consistently doing this for quite some time now. On next weekend's video, we're going to take a look at this within silver. Now, like I stated on the LBMA webpage, they do not have the AM and PM levels, but the SLV has a time frame where they trade from 9:30 a.m. to 4 p.m. New York time, and, well, quite frankly, if you were to be buying silver at 4 o'clock and selling it at 9:30, you'd be doing all right. And I'll display that on next weekend's video. So thank you for tuning in, and have yourself a magnificent week. Bye-bye.